Over the past decade, investing has completely changed. More people than ever are choosing simple and long-term strategies, and ETFs have become one of the most popular ways to do it. They're affordable, flexible, and give you exposure to entire markets with just one investment. But what exactly is an ETF? What types are there? What kind of fees should you expect? And how do you actually go about buying one? Watch through to the end and you'll know everything you need to start investing in ETFs. Disclaimer: this video is for educational and entertainment purposes only and does not constitute financial advice. Always conduct your own research or consult a licensed financial professional before making any investment decisions. An ETF or exchange-traded fund is like a basket of investments usually made up of stocks. Instead of buying individual companies one by one, you're buying the whole basket in a single trade. It works just like a regular stock. You can buy it, hold it, or sell it anytime the market is open. To make things simple, I've divided ETFs into 3 main categories: by strategy, by market exposure, and by dividend type. Let's start with the first one, strategy, which breaks down into active and passive ETFs. Firstly, we have the passive ETFs, the simpler and more common option for most investors. Passive ETFs are designed to track the performance of a specific index. But what exactly is an index? An index is basically a list or a group of companies that represent a certain part of the market. Think of it like a basketball league leaderboard. The best performing teams rise to the top and weaker teams fall off the list is always changing based on performance. In the same way, an index is continuously updated to reflect the strongest or most relevant companies in that part of the market. And one of the biggest advantages of passive ETFs is the cost. Because there's no fund manager actively picking stocks or making complex decisions every day, the fees are usually much lower than with actively managed funds. These fees are called the expense ratio. And for passive ETFs, they usually range from around 0.03% to 0.3%. That's an impressively low expense ratio. Now, you might be wondering, how do you actually pay the expense ratio? The good news is you don't have to do anything manually. The fee is automatically taken out by the fund. A tiny amount is deducted from the ETF's value over time. You won't see a charge on your account, but the return you get is slightly reduced to account for that fee. For example, let's say you invest $1,000 in a passive ETF with a 0.05% expense ratio. That means you're paying just 50 cents per year in fees. Now, these are some of the most popular types of passive ones. US market ETFs. They typically track indexes like the S&P 500, which includes 500 of the largest and most established companies in the US. Think Apple, Microsoft, Amazon, or Google. By buying one of these ETFs, you instantly own a small piece of hundreds of leading American companies. As you can see in this map, this index covers lots of different sectors like technology, finance, healthcare, and a lot more. This chart gives us a clear picture of how the S&P 500 has performed year by year. As you can see, most years show positive returns marked in green, but there are some down years too. Still, over the long run, the S&P 500 has delivered an average annual return of around 8 to 10%. The types of investments I talk about in this video are meant for the long term. If you need access to your money in the short term, it's usually better to keep it in a high-yield savings account or something low risk. International market ETFs. These track companies based outside the US in regions like Europe, Japan, Australia, and other developed markets. An example of a popular international ETF is one that tracks the MSCI World Index. This index includes around 1,300 companies from 23 developed countries around the world like Japan, the UK, Canada, Germany, and many others including 70% of the US. So even though it's called World, it focuses on developed markets and gives you exposure to a broad mix of global economies. As you can see here on the fact sheet, the largest holdings in this index are very similar to the ones of the S&P 500. This overlap shows how influential US companies are in the global market. But remember, the MSCI World also gives you exposure to other developed markets, adding valuable diversity to your portfolio. Emerging market ETFs. These focus on fast-growing countries such as India, Brazil, China, or countries in Southeast Asia or Latin America. The companies in these markets often have more room for growth, which means higher potential return, but also more volatility. Emerging markets can be great for long-term investors who are comfortable with taking on a bit more risk for the chance at higher growth. Small-cap ETFs. These ETFs track smaller companies, often ones that are just starting to grow or have high potential in niche areas. Small-cap stocks can be more volatile and react more to economic changes, but over the long term, they can also deliver strong returns. Passive small-cap. ETFs let you invest in hundreds of these smaller businesses at once, without having to bet on any single company. Now, unlike passive ETFs that simply follow an index, active ETFs are run by professional fund managers who try to beat the market. That means they're actively choosing which investments to include in the fund based on research, forecasts, and strategy, hoping to get better results than just tracking an index. That might sound great. After all, who wouldn't want to beat the market? But in reality, it's not as easy as it sounds. First, performance isn't guaranteed. While some active funds may outperform the market in certain years, many struggle to consistently beat their benchmarks over the long term. And second, the fees. Because you're paying for that active management, the research, and the team, active ETFs usually have higher expense ratios than passive ones. It might be above 0.5% or even 1%. So, with active ETFs, you're paying more, but there's no guarantee you'll get more in return. ETFs can also be grouped by the types of companies they focus on, like by sector or by market capitalization. There are also some ETFs that invest in companies from a specific industry, such as technology, energy, or financials. So, if you believe a certain sector is going to grow, these ETFs let you invest in just that slice of the market. There are also ETFs based on the company size, like large cap, mid cap, or small cap. And just like other ETFs, these can be passively managed or actively managed with a fund manager making the investment decisions. The fund strategy is usually indicated in its description or fact sheet, so it's always good to check. Another difference between ETFs is how they handle dividends, the payments companies make to shareholders. Some ETFs are distributing, which means they pay the dividends out to you usually every few months. That can be nice if you want a bit of regular income. Others are accumulating, which means they automatically reinvest the dividends back into the fund. You don't see the money, but your investment quietly grows in the background. Now, here's something worth knowing. In some countries, dividends are taxed when you receive them. So, accumulating ETFs can sometimes be more tax efficient since you're not actually getting the cash. But this depends a lot on where you live and the type of account you're using. So, it's a detail worth checking out if you're not sure. Before you jump into buying your first ETF, there are a few important things to consider. You'll need a brokerage account to buy ETFs. Look for one that's beginner-friendly, has low fees, and offers access to the ETFs you're interested in. Ask yourself, why am I investing? Are you saving for retirement? Do you need the money in the short term? As always, find your risk tolerance, timeline, and goals. And finally, here are some common mistakes to avoid. Number 1, chasing past performance. Just because an ETF has done well recently doesn't mean it will keep doing so, and vice versa. Always do your own research before investing. Number 2, ignoring expense ratios. Even small fees can add up over time. A 1% expense ratio may not sound like much, but it can seriously eat into long-term gains. Before you buy an ETF, it's a good idea to think about whether the fees make sense for what you're getting. For example, in a passive ETF, fees are usually very low. Number 3, lack of diversification. Don't put everything into one sector. Even with ETFs, spreading your money across different areas helps reduce risk. And last but not least, not really understanding what you're buying. Always take your time to look into what's actually inside an ETF, the companies, the region, the strategy. If it sounds confusing, look for something simpler, and that's everything for this ETF guide. I hope the video helped you feel more confident about getting started. If you found it useful, please consider liking and subscribing. If you enjoyed this one, you'll probably like this next video too. Thanks so much for watching, and see you again very soon.